Carson, great to have you. But before we unpack that whole statement, for those not familiar with this company, how did it reach your desk? How did you start looking into it, and what did you find?
Well, it's one of these. So we have spent some time recently looking into these ESG type companies, and it's just one that seems, first of all, on a valuation basis. I mean, even if you forget about how much of the income is actually non-cash versus cash, it was just expensive. And it's one of these things where it seemed a little bit too good to be true. We noticed that disclosures about their EMIs, so these are companies that they take minority investment stakes in, that the disclosures had declined significantly over the years. And when we see something where a material part of the business where the disclosures are declining, that always piques our interest. So we dug in, and it took a lot of digging. I mean, when the company doesn't disclose much, I mean, we really had to go to a lot of different places. So, for example, joint venture partners, their filings, to understand what's going on at these investee EMIs. We looked at Delaware UCC filings. So, and we spoke to former employees. So we had to do a lot of digging, and it took several months, but it's a pretty extraordinary story. And, just partly to address what they said, but the crazy thing is, I mean, given the misrepresentation of, cash, of non-cash income as cash, I mean, there's nothing that we see that's illegal. Right, that's just how crazy the income.
You're saying. Sorry to interrupt, but just you're saying that they're understating earnings. Is that the bottom line through accounting?
So the main sin that this company commits, and this is not illegal, but there's very odd accounting that occurs with these renewable projects, because you often have what's called a tax equity investor. And the tax equity investor is effectively investing in the tax credit. So once they've used their tax credit, then there's this book value adjustment that occurs for the other investor in there. Now, HASI ends up, and it can choose to offset this, but it ends up taking that book value adjustment, even though it's not HASI's tax credit, even though it never got any cash from this tax equity investor, it takes this effectively, their tax credit, more or less the value of it, and it runs it through as its own income. So its EMIs are actually, by and large, losing significant amounts of money. So, for example, its largest EMI by assets, Jupiter, last year lost about $380 million. And it looks like HASI recorded income, non-cash income from Jupiter of about $200 million. So what I want to rephrase that, rather than taking a share of this $380 million loss, HASI, through the magic of this special accounting that applies to renewable energy projects, said, actually, why don't we say that we got profit from this of $200 million? So that's really the core of what HASI does. And this is cash. It will never receive this cash. What it does is it reverses that income gradually over 20 years. And so it's going to reverse that at about $10 million a year.